Your money wants to work for you. It wants to make you more money. It's just waiting for you to put it to work. That is why the most important thing you need to understand in your 20s is financial literacy. The idea of buying your independence. What does that mean? What does that look like? Can you actually pay for independence? This is how you should look at putting money away. Don't think of it as savings or investments. Literally think about it as buying your independence. What does this look like in real time? When you invest, you are putting money away for a significant portion of time. So if you are around 20 years old, you likely won't be seeing this money until at least 35, 40, 45 years old. So you are putting your money away to make more money so that when you get that money back, there is more of that money to take back. Hello, my name is Kyle, and growing your wealth is one of 4 different pillars to creating your best human. I have a passion for all things finance, fitness, wellness, and gratitude. Today's video is part 3 of the Know Your Money series, and in today's video we are going to be talking about how to know what to invest in and what to look out for before making these investments. Picture this. You have raised your money over the past couple years through your previous work experience, and now your money is at the age where they are ready to go to boarding school. So what do? You send your money away to this boarding school for years and years and years, all so that they can finally work for you. You do not work for money, your money works for you. And this boarding school that your money's in, it's not a 4-year stint. No. This is long-term boarding school where your money is going to work for you. It will grow and grow and grow and will attract more money so that by the time it comes back to you, by the time it is ready to come on home, it will bring 100-fold the money back to you. That might be slightly exaggerated, but you get the idea. How exactly does this work? I recommend you guys first watch last week's video, which talks about investing, the different kinds of investment accounts, and what platforms to use in order to invest. Once you have watched that video and now have the understanding, now it is time for this video. The specifics, the numbers. Now, depending on your risk tolerance, you might choose safer investments or you might choose riskier investments. The good thing about being young is you do not need to be risk adverse. You do not need to worry about the volatility of certain funds. A volatile investment means that you could put in $10,000 and in the next month or two you'd be around $6,000 or $7,000.
What? Oh my god, panic. I've lost so much money.
Yes, but technically no, because when we put this money away, we are putting it away for the long haul, for the 30 to 40 year period, which means that while yes, sometimes there may be a significant dip, it will bounce back eventually, and it will get up to regular numbers and then exceeding its regular interest. So what this means is that a risk tolerant person can handle a more volatile market over a longer period of time. A risk adverse person, usually people who are a little bit older, maybe seniors, maybe people approaching that age where they want sure bets of guaranteed small investments. So their gain might be only 3 to 5%, but they know that it is very likely that those numbers will stay exact and will not dip below and have them lose money. The last thing that we want as we get closer to our retirement age is to be losing money. We've saved up all of this time investing and sending our money away to boarding school. We do not want to lose any of that nearing the senior ages of our lives. A risk-tolerant person, which is typically younger folks like me and you, we can handle a more volatile environment, which also means we can handle funds that make anywhere from 10 to 15 to 20%. Now, it is rare to have super big return numbers like that on a consistent basis. However, there is always the potential for higher market returns. Now, getting back to the numbers, if you are 18 years old and you put $200 a month into an investment, let's just say the S&P 500, for example. The S&P 500 is the USA's largest 500 companies, which usually tracks somewhere between 8 to 10% growth year over year. If you put these $200 away every single month for the next 7 years, so up until you're 25 years old, you will have approximately $24,000 to your name. And if I didn't mention this before, we're assuming about a 10% return. Now you might be thinking,
Kyle, $200 a month? That's about $17,000 of my own contributions.
Yes, but not only did you make a free $7,000 over those 7 years, you are also now 25 years old, an age at which you can likely start to put away more money as time goes on. Not only that, what you have developed over those past 7 years is a very good money habit. You have the discipline to put away $200 of every single paycheck that you make. Or I guess in this case, it'd be $100 every paycheck if you're getting paid bi-weekly. That's besides the point. You have the habit of putting your money away so that it can grow and work for you over time. Now, let's say at age 25, you're now able to put $750 away into that same investment. So still S&P 500, still assuming that 10% return. After about 10 years, you will have approximately $213,000. And half of that will have been compound interest. So you see why time is now the most powerful variable in the investment game. Now, if that number doesn't surprise you, good. It means you're hungry, you're looking for more money, and that's always a good thing. So in that case, we have but one option: make more money. How to do this effectively? Ownership. Own assets, own real estate, own shares of companies like you're doing right now with your investments. Only through ownership and creating things that people need can we begin to generate wealth beyond a regular job. Now, these are all ways to increase your income, but the crazy part is that very few people can actually commit to doing something like this long term. And I say long term, yes, it may take 5 years, maybe 10, maybe 15 to create some sort of great wealth that exceeds your regular job. There's always the potential to be exceeding way more than what your job used to pay. So weigh your pros and cons. Does it make sense for you? If so, what business are you starting? So if you're watching this and you do have investments or you have started a business, high five. That was my way of high-fiving you. So good job, great job. You're doing better than most. Let's keep that going. I would like to state, and this is very important, that I am in no way a financial advisor, and everything that I am saying right now should be taken with a grain of salt and as just one person's opinion on the internet. I would just like to provide awareness to what is out there and the possibilities that are there for you. And it is up to you to fully commit and to do your research and your due diligence yourself, and or reach out to a financial advisor if deemed necessary. So now with that out of the way, it's time to talk about the 3 most important places that people put their money. I'm going to be teaching you guys this the same way that I learned. It took me hours and hours and hours to teach this, so I'm going to try to condense that and give it to you the same way that I would have learned it. So with that being said, mutual funds. Now, this is a fund managed by a fund manager who compiles a bunch of different companies together and pools people's money together. So yes, it is a pooled investment where every dollar that you put into this gets allocated based on the percentage of what companies are involved in this fund. For example, if Nvidia takes up 20% of this fund and Microsoft takes up 15% and Meta takes up 5%, the list goes on and on and on, and the numbers get smaller and smaller and smaller. That percentage determines where every dollar that you put into this fund goes. What's important with mutual funds is that you must research the fund manager and the history of their funds. So if they do have a strong history of managing funds and financial intelligence, then by all means, go ahead. And you also want to check out the history of the fund itself, the one that you want to invest in. Check the history on that. A fund that started last year may have returns of 22%, but because it just opened recently, it might have just been a fantastic year, and there isn't history to show over time what the average return is. And always keep in mind the 6 to 10% average, again going with the S&P, the biggest index out there. It does make a return between 8 to 10%, and sometimes people use that 6% just as a conservative number, worst case scenario. Mutual funds are in fact traded once per day at their net asset value. So at the closing time of every single day, your funds are traded the one time, purchased at the price at the closing time. Fund managers also take a percentage of your contributions and its growth. Please note that with mutual funds, there is a term known as the management expense ratio, which is a percentage of your contributions and or growth, which can reduce your overall growth. The MER consists of your management fees, operational fees, and even taxes. So the bigger the number, the more money that you don't get. ETFs, or exchange traded funds, are very similar to mutual funds. However, they don't typically have a person actively managing the fund itself, so they're more passively managed, meaning the MER, the management expense ratio, is typically a little bit lower. The range is usually between 0.1 to about 2% for both ETFs and mutual funds, with majority of mutual funds being a little bit on the higher end compared to the ETFs. Now with mutual funds, the fund manager tries to outperform ETFs and standard indexes, which is really hard to do. It's really hard to predict which companies are going to do extremely well, better than an index can. And that's why a lot of people do vouch for the ETFs, because they just try to match and track a regular index fund. The benefit of going with mutual funds and ETFs, especially in the beginning, so if you are a young person like I am, doing a mutual fund and an ETF can help to get you diversified. What does this mean? Your contribution buys many companies that are involved in the funds and ETFs that you buy into. And hopefully, if you've done your research properly, you are well diversified in your market sectors. So instead of being 100% only in tech investments, you have a little bit of tech, you have a little bit of agriculture, you have a little bit of medical. Now, I'm not telling you exactly what to go into. That is not my place here. I just want to let you know that the more diversified your investments are, the safer off you are. So if something like tech really explodes, awesome, great, you want to be into tech a little bit. But if something else really tanks, you have so many other sectors that you're a part of that it doesn't really hurt you that bad. And the third here are individual shares. Something like if you have $100 and you want to buy Nvidia stock with $100, you've now just purchased 100% Nvidia stock. So you are not diversified at all. Now, I was recommended by a financial advisor to stay away from individual stocks at this time, just because I am entering the game. I'm still fresh into the game. And so being more diversified and just putting money away into my investments on a regular monthly basis would be the way to go for the entry level game. So by now, I hope you have watched the previous 2 videos along with this one, and you now understand how to allocate your money, how to choose which brokerages and which types of accounts to invest with, and finally, what actually to invest in once you've chosen your brokerage. One of my next videos will talk about dollar cost averaging versus lump sum investing, so like and subscribe to see more. That's it from me, guys. Take care.